Welcome to another podcast. My special guest here is Maureen McCann. She's the co-founder of Spartan Invest, and I am Seewing Yi from the Yi Real Estate Network, our company, our real estate investment club. That is, we've been taking our investors mainly from California to buy out-of-state properties for many years, up to 20 years, and we go into a market, we get in front of the market, we get in front of the change and before everybody else gets there. So that's one thing that we've been doing. So it's all about, as a risk investor out there, you have to adapt, you have to adjust to what's going on with the changing dynamics of the real estate environment out there. And I'm sure all of you have acknowledged in the past almost 24 months, ever since the pandemic has begun, we have gone through a seismic shift and in real estate investing. So either you adapt or you die. So I hate to be so blunt about it. So our investors, and of course our investors and Maureen McCann and your investors, we are, in a way, we have a similar core values and core philosophy. We use the turnkey approach, and we help investors from all the country, all over the world, for that matter, to buy cash flow turnkey properties and get in front of the change and achieve financial freedom goals in 5 to 10 years or whatever. So with that in mind, so today's topic. Oh, Maureen, welcome. Thank you for your time.
Pleasure to be here as always, Seewing. I get energized by you, so I cannot wait to see what we're going to jump into today. Let's do it.
Yep, that's the fun of it. That's the surprise of it. So today, the topic, with that in mind, the topic was going to be let's get in front. Let's adapt to your situation. So before I will share a slideshow, this presentation should not be more than 25 minutes. So let's keep everything at high level. so much to cover, so little time. But anyway, so today we're going to discuss what's going on. Okay, look, we all been hearing there is at least, especially the last couple of years, skyrocketing record price gains for all over the country, skyrocketing rents, and it's free. It's just a lot of investors are confused out there. At the same time, the investors that pulled the trigger in the last few years and prior, you know who you are. You have won the real estate lottery. Okay, I congratulate you. I have a number of investors who did that. Maureen, you can see the same thing to your database of investors. They are happy campers right now because, especially during the pandemic, that's when your investors and our investors have took action. That's the key. So, with that in mind, so let's see what's going on. So, what's going on right now is that I'm sure most of you agree that the best areas to invest for a lot of reasons are in the South and Southeast. And a lot of my investors, they have purchased property in the last few years in Texas and Florida and North Carolina, for example, like Austin and Central Texas, and a few other places in Texas and Florida, and also in Tampa, Florida, and Central Florida and Southwest Florida, and also North Carolina, Raleigh, Charlotte. So like 2 years ago, those prices of a single family home residential investing at that time was like 150,000. I kid you not, like $200,000, and it rents for like $1,400. So at 20% down, it cash flows nicely. So many investors, not only ours, from all over the country, all over the world for that matter, have plunged into those markets. And the past 2 years, we have seen 20, 30, 50% appreciation of those markets. This is crazy. This is historic, right, Maureen?
100%. Never seen it before.
Yeah, it's just shocking. So for those individuals that bought, that's great. You made a windfall for those investors that didn't, well, you know, I don't know what else to say. I mean, you're gonna continue to wait in the sideline or whatever. Not, you know, you need to buy real estate and wait instead of wait to buy real estate. So with that in mind, so let's talk about it. Let's talk about. Oh, actually, I need to pull up my.
Love your slides. We got to see what you got ready for us. See what we got to see.
Yeah. My slides are gone. I can't believe it. You know what I did? Okay, I'm back with my slide.
Yes, I had confidence in you. I knew you could do it, even though you and I are technologically challenged.
Exactly. So, okay, I think we're in. Okay, we're all right. All right. So what we see right now is because of appreciation going on in those markets at 20 to 30% in the past few years, and the rent has barely kept up, although we're seeing skyrocketing rent all over the country, also 10, 20, 30, 40% increases in rent for tenants, for the renters. But still, those hot markets that I've been promoting, like I said, North Carolina and parts of Florida and parts of Texas, what you're seeing is is price. I know the number is kind of hard to see, but let me give you a single family home, investment home in Charlotte, North Carolina, at this moment is around almost $400,000. Yes, the rent has increased as well to $2,200, even $2,300, even $2,400 monthly rent. But you factor in the 25% down payment, but the interest rate for investors right now is like 5.3, 5.5%. So as you can see on this pro forma, you're not going to cash flow. So, you know, some investors, I'm not saying you should not do Austin Metro or Florida or North Carolina anymore, but you look at the numbers, right? You look at the $350,000 to $400,000 single family home investment, even though it's pulling $2,400 monthly. If you look at the higher interest rate, right, skyrocketing interest rate, which is very scary to some people, especially, you know, primary home buyers. But as a real estate investor, that's not a deal breaker. That's not a red flag, Maureen. I'm sure you agree, because as a real estate investor, you look beyond the interest rate. As a matter of fact, 5.3% interest rate is not all that bad, you know, from a historical perspective. Imagine back in the 1980s, the mortgage interest rate was up to 18%. And I'm not kidding you, all right? So 5.3% for investment loan, 30-year fixed rate mortgage is still pretty good. And that should not be a deal breaker, but it'll decrease your cash flow, you know, a little bit. So in this case of a typical market, I'm not saying you don't buy Charlotte or don't buy Raleigh, North Carolina, or don't buy somewhere in Florida, or don't buy in Austin with a similar price, right? You know, 350 to 400K, you know, $2,500 rent, you can still break even cash flow with a 25% down payment with 5.3, 5.4% interest rate. But you have to focus on appreciation potential. So some investors, they may not want to take that risk of relying solely on appreciation potential, even though you're getting a break-even cash flow. So you have to ask yourself, what else can you do? What can you, how, as an investor, what should you do? I mean, you want to have a balance. You want to have a higher cash flow. So I do have a solution, right, Maureen? So, you got
to wrap it up. You're going to wrap it in your hat. So let's see it.
Exactly. So, I consider this market, coincidentally, that Maureen and Spartan invest in. You're a great turnkey provider. So I consider your market what I call hybrid market, right? Hybrid market is a little bit of appreciation and a little bit of cash flow, nothing on one end of the spectrum to the other, right? So hybrid market is different. Well, if you want purely very, very high cash flow, you have to go in the Midwest, kind of a little bit above Alabama. We're talking way like Michigan or Illinois or Ohio or Missouri, somewhere higher up than this map that shows you. In those markets, yeah, you might still see $100,000 duplex that rents for 1,200, whatever. Very, very high cash flow, but the appreciation and the economic trends may not be ideal to some investors. So you get the best of both worlds in this. You know what's so funny about Maureen, what your market that you're presenting to me, and I look at a very high level. Alabama, Tennessee, and North Georgia, this is your market. Your market is kind of weird. I mean, it's kind of in a way that
it like being weird.
Well, let me define that, okay? Let me share with you guys what I mean when I say kind of weird, because you kind of located in the Midwest, right? You're right below the Midwest type of investment model for turnkey investors, and you're also in the South and Southeast. You are not far away from Texas or Florida or Atlanta or Georgia for that matter. So you're right in that borderline. So they give you in my mind, give you the best of both worlds. So with that said, as a listed investor, so again, so this market, I'll show you next. Okay, and then Maureen, your market, you have like Montgomery, Tuscaloosa, Birmingham, and Huntsville, Alabama, and Chattanooga, and few other additional markets coming up this year and next year. You can open up new markets in Tennessee and new markets in northern Georgia, which is right here. But we're not going to get into this. We're not going to go over detail about the future, but suffice to say, Maureen, that I'm happy you guys are you're one of the best turnkey provider anywhere that I ran across, and I've been doing for 20-something years. I work with many turnkey providers over the years in different markets, and our experience with you, it has been top notch. So that's suffice to say. So your market is very enticing to investors. So your market in Alabama, Tennessee is like sort of a secondary market. It's not, it's not on a mainstream media. It's not like trophy market, if you will, like in other areas. In Florida and Texas and a few other places, at least not just yet. But okay, I've been doing this for a long time. So you get in the front end of a growth, right? And where kind of a top secret, kind of under the radar, if you will. So the reason myself, as a real estate investor, that are responsible for several thousand real estate members in my organization, I had to do a lot of research and due diligence to help our investors to identify the upcoming markets in Alabama and Tennessee and northern Georgia. In my mind, is the upcoming market because I look at the numbers, I look at the economic trends. So here are the numbers, and I'll show you right now. Now, look at the inventory listing that Maureen has with us, Spartan Invest. So this is a number, again, I'll go over the high level. Maureen, you're going to chime in momentarily. Thank you for staying silent. I know you don't like to stay silent for too long. You have so much to say. You're dying to get you something out of your words. See, we can stop talking. Give me a chance. But anyway.
Quickly, so I love it. Go.
Quickly, look. I mean, this product. I mean, the numbers really make sense. I mean, instead of buying a $400,000 single-family home in Charlotte or Florida, where the numbers are not making sense because you have to put down payment about $100,000 on 25% down payment on a $400,000 on a $375,000 property in Austin, or outside Austin, that is, or Raleigh, North Carolina, Charlotte, or somewhere in Florida, where your total down payment is $100,000, right? I mean, that's a lot of money for one property. Instead, why not go to a up and coming secondary market, hybrid market, like in Alabama and Tennessee, where you can buy 2 or even 3 properties for the price of one, and you still gonna get a couple $100 of monthly positive cash flow at 20 to 25% down payment at 5.3% interest rate, and still have some good cash flow, a couple $100, $200 to $300 monthly net cash flow, and also some maybe 3 to 5% of a conservative appreciation potential. So you look at the number short term, first year and few years down the road, you can truly see the return. So in this inventory that currently available, which you know what, this one is it an old inventory? I think it is. No.
Those are the new ones. Those are the ones we have available.
Yeah,
right?
this one's the old one. So this inventory was maybe a week ago.
Right.
What's that now?
Oh, yeah, this is, we moved.
Yeah, well, just go to show you, Spartan Invest, they have so many highly motivated investors that have limited inventory. And this type of listings, they're gone within a couple of days. That's how it is, right? So let me give a high level. Look at this part. 145K single family home, probably rent for 1,000. Cash flow 25% down, 5.3% down payment. Similar here, 125K in somewhere in Alabama and Tuscaloosa, only 115K. I mean, this is just the numbers so good. All turnkey, all rehab, tenants in place, professional property management, one-stop shop under one umbrella. What more can you ask for? And this is a duplex, 325K, it'll cash flow. And you sprinkle in with the new builds. The new builds are like 230K, 250K. I know the rent is a little bit low for right now, but the rent should be higher. So don't think about the initial cash flow pro forma. Think about the long term. The rent is going to increase, and so forth, so on. This property, this listing is already gone, but look at the current listing. This is very enticing. So right, you have properties in Birmingham, Alabama. This one is duplex at only 350K duplex. You're not going to find a B class, B location. B is in Bravo. A duplex or rehab. I know they're kind of old, 40, 50, 60 years old, but Spartan Invest, we talk about that some other time, but they use a very, very high quality rehab process to fix these places up, to make it turnkey, to put a renter in there and all that, whole 9 yards. But you're not going to find 350K duplex, get the cash flow, turnkey, ready to go. Similar here, Chattanooga, Tennessee, another duplex, very, very with good cash flow. And then this is a single family home, brand new. You know how hard it is to find a brand new single family home, especially in Alabama. I mean, the mainstream builders, the nationwide national builders, they're not going to build this type of low price new homes for investors. Okay, so because of Spartan Invest unique business model, they have to surround themselves with local builders that are built for investors. Isn't that amazing? And finally, this is another Alabama property. This is a resale, 192K. So also cash flow with maybe $1,400. Yeah, and this listing will be gone in a couple of days, something like that. So see, that's kind of a portfolio you can accumulate for you investors out there. So a lot of investors you have $200,000 or $300,000 cash. You want to create a real estate portfolio. You want diversification, asset allocation. Buy in a good market, safe market. They have a lot of growth potential, and this market is it. And finally, bear with me. Then I got 1 minute left. So this is the typical single-family home, resale homes that you can find in Alabama with a Spartan Invest. I know these numbers are, approximate, is not precise numbers, but even with a 5.3% interest rate, you buy a $176,000 property, all turnkey, ready to go, have a renter ready at rents for like $1,350 with the, and you put only 20% down payment. You look at the monthly debt obligations. At the end of the day, you still achieve almost $300 of monthly net cash flow. And if you look at the upper right-hand corner, you look at the capitalization rate was 7%, rent to value ratio was 0.07. All the numerical metrics really should meet the expectation of a real estate investor. So That is my whole 9 yards. Woo, enough for me. So the remaining 10 minutes is all yours, Maureen. So
take it away.
take it away.
What I just love is you have such an enthusiasm, such a passion. And it really comes through that your love of real estate, and you're doing this, you're not getting paid for this. You're doing this out of the wanting to really be a value and an asset to your listener base, right? It is trying to give them consistent messaging on this very rapidly changing real estate investing world, and our economy. I mean, there's a lot of things that are feel that, a lot of us are home as investors going, what do I do in this type of environment? And you are a voice, a beacon of light that is trying to shed some light on this situation and giving people good advice. So this is why I love to come on these little episodes with you. I never know what the topic is going to be. You throw your slides up there and I'm thinking, okay, let's jump in. So I took a couple notes because I wanted to make sure I hit on these points and came full circle. So there's things that you said. It was hybrid, price, cash flow, increased interest rates. And really right now it is about not so much, it is about changing expectations, but it's looking at a longer vision, right? It's looking beyond year one. So I love what you said about the hybrid market. Now, I think we have to give some of your listeners some context. And the context is this. Seewing's been doing this for 20 years, about 13 here, going on my 14th year. And I have always, it's been like a cardinal rule. You never talk about capital appreciation. It is cash flow all the way with rental properties. That's what you invest for. And that still is tried and true today. But I think we cannot ignore this hybrid market that we are existing in. Let's give you an example, right? California, is it a hybrid market? No, that is a capital appreciation play all the way, right? It is not a cash flow. It's not a cash flow and a capital appreciation market. It's a capital appreciation market. It is pure speculation, right? You buy a house today. I can tell you my neighbor, they just listed their house for 4.5 million. The last one sold for 3.1. I mean, this is an exponential jump. That's California. Do you see that in Alabama? No, you do not. Or some other markets. I did sell in the Dallas-Fort Worth area. I have seen, the prices rose so quickly that the rents trailed behind. You fall, that 1% rule that we're all trying for, it fades away. You're at 0.5, 0.6, 0.7% rent to value ratio. And here's the thing that I've learned is that it really comes down to, it doesn't matter what the interest rate is. The formula for building wealth is buying appreciating assets that cash flow, maybe not as much as the 300-400, it might be 175 to 250, but it's still cash flowing after all your expenses are paid. And then you reduce your tax liability. The wealth formula has never changed no matter what is going on in the economy. Buy appreciating assets that appreciate over time, that cash flow, and that reduce your tax liability. That is how you build wealth. Doesn't matter what the interest rates are. Seewing was making a good point of the hybrid market. The markets we just happen to be in, there's some others I'm sure that are out there, is you've got cash flow and capital appreciation. More so capital appreciation now because of just the economics of low inventory, high demand. We've underbuilt for many, many years, over a decade at least. And now we've got first-time home buyers, Gen Yers, and millennials that are in the first-time home buying. And guess what? They might be marginalized and priced out because the interest rates are making it less affordable. As the house increases in value, the interest rates are increasing. So it makes that monthly mortgage payment just a little bit out of reach. So they're going to wind up renting for a little bit longer, which is great for us, for people that provide rental properties. And then until it gets to a place where the interest rates come down and makes it more affordable, then they'll get back into the market. But until then, we're in this situation where you as an investor coming to decide, you probably went and listened to these seminars, webinars, things maybe even months ago. That might even be outdated information. Whereas if you're looking to invest today, and you were like, you insist, I got to have the 1% rule. I have to have $300 a month cash flow. I think you're going to be on a long hunt, honestly. I think if you shift your expectations, change your expectations, look beyond year one, look to year 5 and 10, holding this asset that has got a fixed rate mortgage against it, assuming you finance. And then you've got rent escalation over that same time period, you're holding the property. And then you factor in, the good runway that I think we have on capital appreciation because we're underbuilt, don't have enough housing. I just went to the best real estate conference last week with Sam Karamian and Oliver Graff. Andrew Greer was there. He's a developer in San Diego, and it's RH Regional Housing San Diego. They look at their housing deficit, and they're over 100,000 units short, and it's only going to get worse coming to 2030. So they can only build about on average 5,000 units a year here. You need 100,000 or more. It's not going to make it's not. We have a housing. So that means for us. And just like Seewing alluded to, if you bought real estate in the last 2 years, man, you hit the lottery, because we've got, 20, 30%, and in some markets, 50% capital appreciation. So get your $25,000 or 25% down on a house, acquire that asset, let the renter pay it down, get the cash flow, even if it's a trickle, take the cash flow, capitalize on the capital appreciation. And if at some point in the future, when the rates come back down and you want to refinance for a lower rate to increase your cash flow, if it's worth the expense to do it for you, then do that. But otherwise, just get in the game.
Yep. Let me say one more thing. Very good high level recap. You just did. It's just a very, very, very good perspective. Let me say a couple more things. The thing I'm about to say is in real time. You know what's going on based on my, based on my current research so far. Let's talk about the second wave of migration, even a third wave of migration. You look at the other markets like Miami, when it's becoming not affordable. Many areas of Florida and Texas, Austin, definitely not affordable. So you find those renters, they are paying $3,000 monthly rent in Miami. The renters are paying $3,000 rent in Austin, and they can't afford to buy. And also the rising appreciation. There are so many unaffordable markets all over the South and Southeast, not to mention the extreme unaffordability of the Western region of the US, California, and Seattle, Washington, and Idaho, and Nevada, and Arizona, and Utah. That region of the US, extreme unaffordability. And people are migrating, people from the Midwest, people from the South and Southeast, in Texas and Florida and Georgia, they're moving to a cheaper area. They are going through, this is my prediction. I don't have raw data, Maureen, but we can revisit this video in about a year from now or even before. And my prediction, if you will, is going to come into fruition. I will see people, renters, instead of paying $2,000 or $3,000 monthly rent, they're going to move into your hybrid market in Alabama, Tennessee, and they're going to pay $1,500, $1,600, $1,700 of rent to rent investment home that investors buying from you guys at 150 to 200K, right? So that's what I see. And then because people cannot, this is a renter's nation. Here's my recap. I know we have to finish up in 2 minutes. People cannot afford to pay high rent in many, many markets. So they're coming into your hybrid market, Alabama, Tennessee. And then people cannot afford to buy a home. Those primary home owners, they've been priced out. So they're going to a cheaper market. Austin, the median price inside Austin right now is like $620,000. This is the mind-boggling, because I've been promoting Austin for a number of years. A mere 3 years ago, the median price inside Austin, I believe, don't quote me, is only about 300,000. Now, $620,000. I mean, shocking, skyrocketing growth. So people cannot afford to buy, they are renting. People that are renting, they cannot afford to rent in other markets. I see, when you look at U-Haul, I'm challenging you or anybody else, look at the research, look at U-Haul migration in the next upcoming 12 months, look at the migration pattern, follow, all the other expert analysis, you will see. We can do another video going back from today, what's going to transpire. Let's see what I just said really resonate.
You know what, I'm going to finish off with this, because I think, I love that you made that prediction. I love that we have this recorded so we can come back to it a year from now. But when you were talking about Austin and you were talking, it made me think of Idaho. These are, and Tennessee, Nashville is another one. So Nashville, Idaho, Boise, Idaho, and Austin, Texas. If you think about if you really think about it, we talk about those areas now because of how quickly they've developed. But they quickly developed because people were escaping less affordable markets and moving towards more affordable markets. Then they've become priced out, and now they've got to go migrate and find another market that is going to be affordable and sustainable for them to provide for their families. That all came to me when you were just talking about that. And I was like, you might absolutely be right, because as unaffordability rises, you have to make a choice as a family. Do I stay and just keep struggling, or do I relocate to an area that's growing? Maybe not my first choice, but it's an area that offers me a job opportunity. I can feed my kids. I can put them in a decent school. I can live close to where we're, and I can have space, because now space is a commodity at our homes. So you actually, if you're right, I'm flying up there and I'm taking you off dinner.
Yep. I got a feeling, I have an intuition. I know it's going to happen. I've been doing this for a long time. Well, only time will tell, but I have to be right. I mean, it's so obvious to me with the trends and the patterns, migration, all those kind of things. Only time will tell. We'll see as we move toward the end of this year and next year. And then for investors, right? You got to get in front of the change. Here's my recap. Here's my 30 seconds, and then you do your 30 seconds recap, and we're done. So my recap is that now that you hear this, now that I gave you this prediction, so as a risk investor, it behooves you to get in early, get it in while the price in your market in Alabama, Tennessee, in Northern Georgia are still low, okay, right? And you lock in the price, you lock in today's interest rate, even though it's 5.3, could be lower, who knows? We don't know the interest rate situation, but yeah, pull the trigger now, and then wait for those economic trends to arrive, and you'll be a happy camper. Then you can thank me. Oh, Seewing, he really, his prediction came true. So thank him for helping. Whatever. All right. So, what is your 30-second final recap?
So it is this, and I think you might have said it before, so it's not my idea. But what I think we should do is I will take one of my properties that just sold this week, a final property that sold this week. And then we are going to do 12 months from now, we are going to do a recap of that particular property on the cash flow, on the capital appreciation, and the loan buy down, and the depreciation for that particular investor. We will present that case so that we can see, did we increase the property value increase? Is the investor better off now that they actually took action today than if they had waited on the sideline for the interest rates to come down when it's more comfortable for them? So I think this is where, you and I talked about this before, it's the actually doing, it's the taking action, it's doing something different that you've never done before to get a different result. And I think this would be an excellent example of how to show people, if you wait, there is a cost to waiting. So let's make this a point. Let's come back a year from today on 4/19/2023. And we are going to review, we'll pick the property. We can probably even take that Plainview property that you saw, or Owens. And we can tease you that we were right. Not that we want to be right. We're just trying to motivate you to create wealth for your family and get over the fear. So let's do that, Seewing. That's my recap. Because we love you. We want to take care of you. We want you to guys take care of your families. And the only way to show it to you or to prove it to you is to show it to you. So let's do that.
Thank you so much for your time. Great doing this with you. Stay tuned for another podcast in the future. Thank you for everyone for attending. Hopefully you have received a lot of value from this presentation, and both Maureen and I will see you on the other side. Take care. Have a nice weekend. Bye.
Bye.